So basically, this is going to cover more than just the first home buying process. But so any questions you have throughout the whole process, let me know.
Okay.
Well, one of the first things we want to talk about is the first time home buyer benefits. If one of the things that you don't necessarily have not have ever had to have owned a home. If you have not owned a home in the last 3 years, that makes you a first time home buyer. So we have a no down payment, and then we can also have some low down payments as low as 3% down. So we have a lot of different mortgage products available. Now the steps in order to buy a home, one of the first things you need to do is explore financing and to get pre-qualified. And we can help you with that, working on the pre-qualification and then going over the different products you would qualify for and to answer any questions you have about that. You know, some people want a 30-year fixed or 20-year fixed. I mean, there's a lot of different products out there. And the next thing is you'd have to explore getting an agent and a buyer's agent, and then signing a contract. From there, you would be looking at homes, you would make offers, and then once you get an accepted offer, you would sign a purchase and sales agreement. And then the next step from that is then we take it from there and we finish up the financing process for you so you could secure the financing. So that's kind of just the 4 basic steps in the home buying process. I mean, it gets a little bit more involved, but that's just the gist of it. So obviously you have your mortgage loan officer, which is me, right? And I'll oversee your application to the closing, like everything, application, documents, questions you may have. I even speak to the agents, work with attorneys sometimes, you know, throughout that. We order the appraisal. And then you'd have the buyer's agent, which works exclusively in the interest of the buyer only, right? And it's really important to have a buyer's agent because the seller's agent has a fiduciary responsibility just to protect the seller. So they're not going to be looking after your interests at all. Now, you don't pay for the buyer's agent. The buyer's agent is compensated from the seller's agent's commission. They split that, and that's how that works. And then, of course, the listing agent, which is like the seller's agent, and they, like I said, they work with the interest of the seller only. And it is their job to try to get the highest possible selling price. That's why the buyer's agent's important, so that they can look out for your interest and negotiate. Like, for example, if you put in an offer and then you get an accepted offer, but then you have a home inspection done and say a few things pop up in the home inspection, your agent then would come back and maybe negotiate that because in order to get it fixed, or maybe they can lower the sales price a little bit because there were a few problems with the property, things of that nature. So they're very important. Then you also have your title company and lender's closing attorney. Now, they work in the interest of the lender, which is us, or the credit union, but they do the title history, they run the closing. It's part of your closing costs as the buyer, but they also will look at your purchase contract. So we have a closed attorneys list. It's really important to protect our members. So they will look at your contract because they also have the responsibility to make sure that your needs are met within this transaction and that legally, you know, you're protected. And that also goes hand in hand with the buyer's attorney. Now you can get your own buyer's attorney if you'd like, but that isn't always necessary, you know, but if you're comfortable. Hi, Maria.
Hi, Liana. We have a question that came through in regards to first-time home buyers. So you mentioned you need to not own a home for 3 years to be considered a first-time home buyer. So if someone sells their current home that they own with a sibling, do they need to wait 3 years before they're considered a first-time home buyer?
Yes. So they have to be considered first-time home buyer. However, we have some really great products that are comparable to the first-time home buyer program. for people that have just sold their home and are looking to purchase.
Okay, so there is the three, for the first time, there's a 3-year cutoff time. Is that, okay,
One of the bars has to at least not owned a home for the last 3 years.
perfect. Thank you.
So where was I? Oh, okay. So the seller's attorney. Now, on the seller's side, they have the seller's attorney who's going to be making sure that the seller's protected legally. And that's paid for by the seller. So that's not your responsibility at all. But the buyer's attorney and the seller's attorney, they do work together to make sure that, that sometimes they end up having to go back and negotiate back and forth, contract dates specifically, things like that. So do you really need a real estate agent? You're not required, but it is recommended. So they have the market knowledge. They'll spend time looking for what you want. They also, you give them your criteria and they can put you on what they call the MLS property finder. And in this market, that's really important because it's a seller's market and properties go on the market, they go very quickly. So a lot of times, first-time home buyers are looking to purchase a property and they think, well, I'll drive around, I'll see what's open, or I'll go online and look. By the time you see that online, it could already be gone. So the property finders that they put you on, they'll get your criteria, and then anything, the moment it comes on the market, you were emailed that right away. So you'll be able to then contact the agent, say, oh, this came through, I want to see it. Can you make an appointment for me to go view the property? So time is of the essence with that. Let's see, they know how to negotiate repairs, which, like I said, that a lot of times falls hand in hand with the home inspection, which is what's done once you have an accepted offer. They can help protect you by including contingency clauses. And what a contingency clause is like, for example, sometimes, for example, if you're a renter and you need, you cannot get out of your lease till say August. The contingency clause would be like, oh, I'm interested in purchasing this property, but we cannot close until my lease expires where I live in August. So that would be a contingency. Sometimes people are selling a property and buying a property, and they'll have what they call a contingency, where it's like, well, I want to buy a property, but it's contingent on me selling this one first. So it's that kind of thing. Yeah, so you want experienced agents that that have a history of making successful offers. I always say that if you're looking for an agent, word of mouth is the best. Friends, family, even, your credit union, your lender, to find somebody that can come highly recommended. It's always the best to do. And then they'll coordinate with all the parties on your behalf. So they'll also be in touch with the attorneys, the other agent, the sellers, so it's not something that you should have to worry about. So going back to the fact that it's a seller's market, there are some of the properties now there are multiple offers on, and it becomes a bidding war. And what happens sometimes, people are offering more than the asking price because of the multiple offers. And that can include an appraisal contingency. And the way it works with banks and lenders for financing, they go on appraised value or sales price, whichever's lowest. So there's a couple of different options. So say, for example, if you went into a bidding war and you bid $350,000 on a house, the initial sales price was say $320,000, but it appraised at $300,000. The lender would only lend $300,000 off of that appraised value because that's the lower of the three. So then the seller has an option either to go ahead and lower the sales price to match the appraised value. Sometimes they'll ask you to make up the difference in cash. But but basically it comes down to renegotiating the deal. And sometimes that's not possible. And then you have to think whether you should walk away or not, or wait it out. I can tell you most people are not looking to, along with the down payment, closing costs, and then having to make up a difference in cash for a home, because owning a home is an asset and you don't want to go into it basically upside down. So what do lenders and credit unions really care about? Well, we care about the income support, the payment, employment and income history, your credit score, and the down payment. If there is a down payment, our first time home buyer program, obviously it's 100% financing, so there's no down payment with that. And then funds for closing costs and escrows. Escrows are for your taxes. So they start what they call an escrow account. It's basically like a savings account. So say if your taxes are $5,000 a year, or $6,000 a year, and then say that comes to $500 a month, they would start with the closing costs. They would hold back a couple of months to get the savings account started for the escrow account for the taxes. So that would be added into the closing costs. Sometimes you don't have to escrow your taxes. That's not always a requirement, but generally, unless you put 20% down, you'll have to escrow your taxes. And most people like doing that anyway, because it's one less worry for them. The bank, the lender pays it when it comes due out of the escrow account. So this is kind of a chart on how you can kind of gauge on what you could possibly qualify for. For example, if you have income of $65,000 and you don't have like a lot of debt, you could take 5 times that and you could possibly get a loan of around $325,000. If you have income, say $65,000, and you got a lot of debt, you got car payments, credit cards, things of that nature, then you could times it by 2.5, and that would give you a loan amount of $162,500. So it's really important when you're purchasing a home to keep your debt to a minimum. Especially don't take out any new debt while you're in the process, because that will affect the max you could qualify for. Generally, with first-time home buyers, we look at 43% debt to income ratio, which would mean your liabilities that show up on your credit report plus the new mortgage payment could not be 43% of your gross monthly salary. Could not exceed that. That's kind of how it's kind of configured. Now, so debt to income ratios, for example. Hi, Maria.
Hi, we have a couple of questions that kind of pertain to what we're talking about. Do we take into consideration student loans when we speak about debt to income ratio?
We do. And even if they're deferred, we have to use like 1% of the student loan. So say if you have a student loan for $3,000, with 1% of that, and factor that in as the monthly liability for it.
Okay, great. And then we have a few other questions. Does Hanscom provide real estate service?
Such as?
I'm assuming a real estate agent. I can speak a little bit to that in regards to, I know that Liane has a lot of contacts, so I'm sure she can refer you to a good real estate agent. I think that was the question. We don't have a real estate agent here, but I know Liane has lots of connections.
Right. So we've worked with quite a few agents that have done, a really super job for our members. So we could recommend them. They're not affiliated with the credit union. They're not employed by the credit union. But we can recommend them because we've seen what they've done with other transactions, so yeah,
Excellent.
Absolutely.
Excellent. And then we have an attendee who will be purchasing a home in 2 to 3 months. And how does the VA loan work, and what do they need to do?
Okay, so we'll go down into that more in depth.
Later on. Okay,
Yeah, we
perfect.
will, absolutely. So, yeah, because that's a government loan and it's a specialized loan. So it's a very nice program. I think it's one of the better purchase programs out there is the VA loans. But right now, when you're looking at debt to housing and income, it's really important, even for VA, to think about this. So you have your gross monthly income if you're a W-2 employee, right? So you take 50% of that. And then you take your monthly debt. And when we talk about monthly debt, banks and lenders look at what shows up on the credit report, which is car payments, personal loans, credit cards. You take that monthly debt, those payments, right? And you subtract that from that 50% of your income. And that shows you how much is left for housing. And when we say it's left for housing, we mean it's left for your principal, your interest, your taxes, your homeowner's insurance, possibly mortgage insurance if it's less than 20% down. And then if it's a condo, you also have an HOA fee, a monthly HOA fee, which is not something that you would pay us for directly, but we take that liability into account. So on employment, you have to have a minimum of 2 years of employment history in your field, which can include education, right? So you can have switched jobs within 2 years, but you have to stay within your field. And that would be fine. As self-employed, it's a little bit different. They want to see 3 years of successful business ownership, sometimes 2 if you have a long history in the industry. So say if you've been a contractor for 30 years, and you just have a new company that just started 2 years ago, that would be fine because you have a history with it. Self-employed income is a little bit different. Whereas like on W-2, they look at the gross monthly income. On self-employed, they go on your adjusted gross income from your tax returns. So when you're trying to figure out what you could qualify for, which by the way, you can just call me. I'm more than happy to help you through that. But keep that in mind that as self-employed, it would definitely be off of your adjusted gross. All right, so obviously you see a lot of things online, like for Zillow, things of that nature, and they'll give you an estimated payment. I kind of take that with a grain of salt, because it doesn't really customize the calculations. Like they'll show a 3% down with no taxes and insurance. Realtor.com does that. Zillow shows the 20% down. So depending on what you're looking to do, really would depend on the payment. So it's always best if you're looking at a property and you're not quite sure, and rates fluctuate daily anyway, as you're more than welcome to call me or email me and say, hey, Liana, we're thinking of putting an offer down on this house. It's for $400,000. Can you give me an idea what our monthly payment would be? And I'm more than happy to work that out for you. So which credit scores use? So obviously, there's 3 credit bureaus, main credit bureaus. There's Experian, Equifax, and TransUnion. So banks and lenders use the middle credit score. If there's 2 applicants, they take the 2 middle credit scores and then use the lower of the 2 of the middle ones. As far as rates go, the 740 and above credit score obviously will get you the best interest rates. 760 above is the best available PMI rates, because private mortgage insurance, which is what you would pay if you put down less than 20%, is credit score driven also. And then we have a minimum credit score of 620. So, and that's for most of all of our loans. And then some of the government loans can go to 580, but that's a little bit of a minefield. I can be honest with you with that, because they're going to have a lot more requirements for those government loans when your credit score is that low. So This for VA, okay, for purchase and construction. So VA obviously has a no down payment. But unless you considered VA disabled, VA has what they call a first time use. It's a funding fee that they put on top of the mortgage of 2.3%. So for example, if you had a purchase price of $350,000, 2.3% of that would be a funding fee that they would put on top of the mortgage for $7,525. So technically you would be financing $357,525. And that's not a bank fee or credit union fee. That's a total VA thing. But once again, and that is with no down payment. Now, if you put 5% down, that funding fee is a little bit less at 1.65%, or 10% is 1.4%. But there isn't any mortgage insurance with the VA loan, but they do have that unless you're VA disabled or exempt. So this is just discussing tax rates. Depending on the towns or sometimes the states you go, they have different tax rates for your properties. It's always best, if you have any questions about that, is to speak to the agents when you're putting an offer. Okay. It's really kind of important when you think of loan products to think what your short-term and long-term goals are. Obviously, you want to buy a home, but how long are you planning on staying in the home? Do you think your income is going to change? So, like for a fixed rate, if you're not planning on moving in the next 10 years, a fixed rate is the most stable loan that you could have. So no matter what happens, with the economy, your rate will not fluctuate. It will stay stable. Then you have your adjustable rates, and they're like for 5 years, 7 years, 10 years, and they're fixed for that period of time, and then it adjusts. So sometimes when people, we live in very transient society, people get transferred around quite a bit. Or some people say, I know that in about 5 years, I'm going to buy another home. Sometimes those adjustable rates, because they can be very enticing with interest rates, people will go ahead and go into that program. But if you're not thinking of doing anything at all within 10 years, I would stay with the fixed rate. It's just more stable. And we obviously do conventional financing, and we offer jumbo products. And our jumbo product pricing is very competitive with our regular conventional pricing. And then we also offer the VA. We don't offer FHA, but we do offer VA. Hi, Maria.
Hello, we have a question that came through.
Sure.
We have an attendee who is PCSing in Tampa, Florida, and they're wondering if they could use the VA, even though they're in the Florida area.
Absolutely.
And with us, we do service all 50 states, correct?
46 states.
46.
Yeah, so we don't service Texas, Hawaii, New York. I'm not quite sure, but I think Alaska. So
excellent.
States. Yeah, absolutely. And you can use your VA at any time. Okay. So here's our first-time homebuyer program. You have to have a 720 plus credit score, 43% max debt to income ratio, 2 months of reserves, and PITIA, which means principal, interest, taxes, and insurance. And when they talk about reserves, it could be like a 401k, stocks and bonds, IRAs. They don't want to touch it. They just want to know that you would have that there in the event that you might need it. No non-occupant co-borrowers, so you have to qualify on your own. The product is a 7-1 ARM. The max loan amount is $548,250, which is the conventional cutoff before it goes to high balance or jumbo. And then it's only in New England, Virginia, Maryland, DC, and it's for single family homes or condos. So no multifamilies. However, if you decide as a first-time home buyer, you wanted to buy multifamily, we do have products available for that, but you would have to put some money down, you know. And, you know, obviously in New England, multifamilies are very, very popular.
So Liana, just real quick on that, the VA loans, are they serviced in New York? You can get a VA loan in New York, correct? It's just that we don't do it.
Yeah, we don't lend in New York.
But
Yeah.
VA, you can get a VA loan in New York.
Oh, sure, absolutely. Yeah.
Thank you.
And in Hawaii too, yeah. So here's some of the upfront costs. For example, so say if you have a, whoops, let me get back, I'm sorry about that. Say if you have a purchase price of 500,000, right? You do a 3% down payment, 15,000. That would give you a loan amount of 485. Now, when we talk about estimated closing costs, we're talking about, like, our fee is only $395, but you have other closing costs that go into a purchase. You have the attorney's fees, you have title insurance, you have prepaids, you have your possible escrows for your taxes. And then the attorneys have to record with the city, town, sometimes the state. Sometimes you have, depending on the state, you have transfer taxes. So say you'd have about $6,000 in closing costs. Your prepaids and escrows, keep in mind for the taxes, could be about $4,000. So estimated cash to close with everything, with the down payment, the closing costs, and the escrows, could run you around $25,000 altogether. So that's something to take into account. So when people are thinking about how much money they have to bring to the table, it's very important to think about the down payment and the closing costs combined. Hi, Maria.
So we have a question in regards to closing costs. Could you explain what that is? Do you have to pay closing costs with your own personal cash? What exactly is in closing costs?
Yeah, so closing costs, obviously, when you're purchasing a home, there are a lot of fees that go into that. A lot of, like I said, our fees only $395. So the majority fees are legal. You know, you got your attorney's fees, you've got your settlement fees, you've got escrows for taxes, starting the escrow account. They have to do recording fees because they have to record your the lien to the towns. And so you receive a title commitment. So there's different fees that go into it like that, depending. Sometimes, like if you're buying a condo, there may be some sort of a condo fee because, you know, the bank or the lender has to get the condo docs, to, like the master policy, the budgets, things of that nature, and condo associations charge for that. So there's the appraisal, that's a fee that goes into it. So if you're looking to finance a property, appraisal has to be done. And those usually run around $450. But they can be a little pricier than that, but usually around $450. So that kind of all adds up. Now, they do have a thing called seller's concession. And what that is if you have, so you put in an offer for a property and your agent can ask for seller's concession, which means the seller would offer to pay part or all of your closing costs. So, you know, that's a negotiation between the agents. That's nothing that the bank gets involved in, but it's done quite a bit, you know, and they're not actually doing you that much a favor. So for example, if you were buying a house for $300,000 and you said, you know, I'll go ahead and I'll offer the $300,000, but I need $5,000 in seller's concession, they would rewrite the contract to do a sales price of $305,000. So you are actually going to be financing it in. But it is a way that you don't have to come up with that money at the table. So it's something to think about when you're out searching for a home and you speak to your agents. So acceptable down payments, like money in your checking and savings account. Keep in mind, due to the Patriot Act, money has to be sourced, which means, like, I had a gentleman one time that had gold in a safe, and we couldn't utilize that because you couldn't source it. So money has to be able to be sourced. So like, you've got your money in your checking account, savings account. There's seasoned accounts. You can get a gift letter a lot of times, like not so much for 100%, but for the other products, a gift letter, say from a family member that would gift you a little money for the down, to help with the down payment. So we have a standardized gift letter that they could fill out and sign. Sometimes people use the net equity funds from the sale of an existing home. Or, they borrow from themselves. So like, they borrow from the retirement account or the 401k. So that's all acceptable down payment sources. But, money in your mattress, not acceptable. Okay, so title insurance. So title insurance is going to be part of the closing costs, and it's really important. So the attorneys go back like 50 years searching your title. And the reason it's really important is you don't want somebody popping up from 50 years ago, like an heir, and that has a piece of paper that said this was actually my great-grandfather's land. So that's what title insurance protects you from. And also defects on the title. So like a fraudulent sale, purchase, a tree removal, a legal battle of ownership, which I just mentioned, loss protection. So title insurance is very important. Now they have two things. They have owner's title insurance and lender's title insurance policy. The lender's title insurance policy you would pay for. And so if something, God forbid, came up that the loan that you financed would be covered under the lender's title insurance policy. But that's all, it would just cover that. So that's why a lot of buyers go ahead and get the owner's title insurance policy to also have that protection for themselves. However, owner's title insurance policy is an optional expense. So you don't necessarily have to take it out. Some people do, some people don't, and I always have them speak to the attorneys about it. And to get a better understanding if maybe they should or they shouldn't get it, because we're not ever going to force a buyer to do that either way. Now, there are obviously you'll see a lot of properties listed, sometimes you see foreclosures or short sales, distressed as is. The problem with some of these foreclosures, short sales, distressed is the condition that the properties are in. And because the conditions are so bad that it's very hard to get financing for it, because technically per Fannie Mae guidelines and FHA, USDA, VA, it has to be a livable property. So keep that in mind. And short sales have to go through this whole process with the lender that currently has the property. And 90% of the time, they never get approved, and it can drag on for 6 months to a year, just seeing if you can get approved for a short sale. So that's kind of something to keep in mind when you're looking at properties. The old saying, if it's too good to be true, it probably is. So, and then you have to have things like, for example, sometimes they don't have a working Title V. That's very important. So it's something to consider when you're looking for a home. But a seasoned agent, once again, a buyer's agent, will be the first one to, talk to you about that property, because a really good agent will have done their research on that property and let you know, like, oh, you're not going to be able to get financing on it. There's no point in putting an offer, that kind of thing. So things to avoid while in process. So avoid changing jobs or becoming self-employed. So the problem with it is like, if you are a W-2 employee and you change jobs, but you stay in the same field, that's fine. But if you go from W-2 to self-employed, then you're now going to have 2 years of self-employed income before you're eligible for financing. So it's very important to kind of, if you can, obviously, to avoid changing jobs. avoid making big ticket purchases prior to closing. So all banks and lenders initially get pre-qualified, your credit is pulled. Then right before closing, banks and lenders update your credit. If you have now any big ticket purchase items, new debt, that will factor against your liabilities. And first-time home buyers have absolutely lost homes because they had purchased a car and now they no longer qualified. Their debt to income ratios became too high. So I always tell people, avoid using your credit cards as much as possible, no big ticket purchase items, just kind of stay status quo until after you purchase your home. And then it's really important to make sure that you don't let any of your payments fall behind, because once again, your credit score will fall, and right toward the end, they will pull your credit. And if your credit score is fallen, that may also affect you being able to get a loan. It's very important, not to, if you're saving some money to purchase a home, try to make sure that you don't tap into that. So the money that you have initially when we pre-qualify you or pre-approve you, make sure you still have that money toward the end, because if you don't, it's going to be a big problem for closing. And then try to keep your bank accounts the same, because banks and lenders have to verify your assets. So if you're changing around bank accounts, it starts to make it very difficult to do that. And then avoid co-signing for anyone. And this happens a lot with people with student loans, for example, parents co-signing for their children's student loans. Anything you co-sign, even though you're saying, well, I co-signed for my brother car, but he's going to make the payment, that full liability will still count against you. So it can affect your debt to income ratios. So I guess the idea is, does it make sense to purchase a home, right? Renting versus owning. Now, a lot of people say, well, my monthly payment for purchasing a home would be much less than renting, and that is true. The rental market, obviously in Massachusetts, especially, the rents are very, very high. But you also have to look at it that a home is an asset. So you have to think about, if you pay even a little bit more for a mortgage or more for a property, in the long run, what will that help you financially? Because, for example, you want to make sure you buy a home in an area where property values consistently go up, or, and you have to look at things. You have to look at the schools, you have to look at property taxes, because property taxes will consistently go up on the property. And then, a lot of times they'll recommend putting some money aside. So for example, if you're paying $1,650 a month now, and a new mortgage payment would be about $2,200, then put the difference in a savings account and see how it feels to live without that extra money, because it's really kind of important, to be able, because you have to live, right? You want to make sure, because the one thing that banks and lenders don't take into account, they don't take into account things like internet, utilities, gas for the car. So these are all going to be expenses that you also will have, food, so if you can live comfortably making $2,200 a month, for example, say that would be the mortgage payment, even though right now you're only paying $1,650 a month in rent, then that you're not going to hurt yourself, financially. Anyway, so that pretty much covers most of it. Hi, guys. I'm always available for questions. You can always email me or call me directly. It's really important for us at Hanscom, especially for first-time home buyers, for you to be comfortable with the process. So we want to know that when you sit down at the closing table and you're going to be signing for hundreds and thousands of dollars, that all your questions have been answered. And there's no such thing as a silly question. So any questions you have, any concerns, I'm always available.
So Liana, we had some questions come through.
Yeah.
In